With all due respect to the other panelists and the other panels, this is my favorite. Uh, and I guess I'm going to show my true colors. I do tend to lean somewhat towards the market side of markets versus mandates. In fact, last night, Matt Kahn at dinner gave me, I suppose, an ultimate compliment. He said, "How does it feel to know that when you started talking about what I call free market environmentalism, that now it's kind of mainstream? How do you feel?" And well, I don't take much credit for that, but to the last few slides from Nick's and my presentation, I think we have moved in that direction in the environmental area at least, and more people are searching for market solutions. This panel on adaptation, and the two people who are going to talk about it will illustrate this, I think follows nicely on the cost-benefit panel in that adaptation is something that gets so little attention and yet has such huge potential benefits, and that dwarf these other kinds of drive Teslas in Montana mandates. But I want to make sure in this panel that we distinguish between two ways that people, I think this is correct, think about adaptation. One of them is adaptation by building houses up higher, putting them on stilts so when the flow comes from the hurricane flood, storm surge, it's getting your post, not your living room. Or putting up dikes. I think the Dutch have understood this one for a long time. That kind of adaptation. And it's an important kind of adaptation to think about in the context of climate change. But there's another kind of adaptation, and it's one that I think about the most, and it is, this goes back to Tom Sowell's quote, really, what are the incentives that people have to take account of the information that's out there that suggests that maybe there is some climate change, there are some climate change effects that you should worry about. And in this context, to me, there are two markets that are really three markets, I guess I'd say, that are extremely important to remove barriers that send the wrong signals, the wrong incentives. And I'll just say what the markets are, and we can then talk in Q&A about how well they work. But one market is real estate. And the real estate market reflects people's assessment of climate change. If you look at data from a Harvard study in Dade County, Florida, it's evidence that people are saying, let's move a little higher up because of the storm surge. And the prices of housing are reflecting that. The question to be answered is, are they reflecting it well? Do people really understand what's happening out there? Do they know these prices? And the part of the answer is real estate people do. So real estate markets is one. The second one is finance markets. These markets are all about assessing risk, and they've been doing it for ever. And that market, that finance market that reflects people's assessment of the risks of climate change is, I think, extremely important in whether people adapt. And finally, the insurance markets. And of course, these are heavily regulated markets and have much less, I think the information is truncated in ways that people don't necessarily get what they would need to say, gee, my house, oops, and I didn't mean that in a colloquial sense, I meant that in the context of my house, is actually in a pretty fire-prone area, and what should we do about it? And the first thing Monica and I did when we bought the house was we took 200 tons of logs off the property. But the damn things are growing back, so now we have to do it again. And we don't really see that in our insurance rates, and I think they don't reflect the true risk that we probably have. But we don't want to lose the house regardless of those insurance rates, and so we're taking action for other reasons. At any rate, those are three markets that I think are part of climate change and fit in well to this concept, this panel on adaptation. So with that, I will turn it over to two people who really know a great deal about adaptation, Matt Kahn, followed by Andrew Plantinga. Prepare yourself for a drink from the water or the fire hose, please.
Oh, folks, I'm delighted to be here, and I'm learning. So you're about to hear two microeconomics talks and an optimistic talk about the role of markets in helping us to adapt to climate change. And if I were a betting man, if there could be another Paul Ehrlich, Julian Simon bet, I actually think that the social cost of carbon is going to decline over time because of successful adaptation along some of the lines I'm going to be talking about over the next 14 minutes. So folks, I'm very concerned about youth pessimism. I teach a lot of young people. I'm the father to a young person. I interact with many young people. And this youth pessimism about their future, the potential that this could be a self-fulfilling prophecy, scares me. My mother warns me against wishful thinking and magical thinking, and I will leave it to you to decide whether you agree with the arguments I'm going to lay out. I'm quite optimistic about our economic future for some of the reasons that Bjorn laid out in the previous session. So I spend my time on Bjorn's Facebook page, and so this is data. This is optimistic data. So time goes from 1920 to roughly the present, and on the vertical axis are deaths per year from climate-related deaths. And folks, I see tremendous progress, and I celebrate this. And this isn't even scaling by population. And so during a time when we are successfully, that recent earthquake in Taiwan, it's horrible that anyone died, but it's terrific of how low the death rate was with a Richter scale disaster of 7.4. We're getting better and better at taking a punch. And Terry, I ask you, is that due to markets or mandates? I'm going to get a tattoo that poses this. I want to make the case that it's markets and that we can do even better. How do we set up the rules of the game to unleash capitalism to address the known unknowns we face? Many of us are risk averse. How do we use markets to protect ourselves? And how can we align government activity such that it's a complement and doesn't crowd out market innovation activity? And these are the questions I work at when I'm at Hoover or when I'm in LA sunning myself. And so folks, these are two books that didn't sell, that didn't earn their advances. And so if any of this interests you, I'm always hawking books, and I have many in the trunk of my electric vehicle. So folks, what I've been up to recently, I want to talk about a couple of micro markets, and Andrew's going to give a terrific presentation on insurance markets, so I tried to remove that from my brief talk. What I've been up to recently with Amin and Erkin is basically don't put all your eggs in one basket. We have built homes in fire zones. Most of our homes are durable, and when they sell, lenders now have a loan on their books which faces some fire risk and thus prepayment risk and default risk on those loans. In this paper that I'm pretty excited about, we document the success of the securitization industry in the United States. So what goes on? The United States is a big nation, and in building these securities, the securitizers are forming a spatially diversified portfolio. They're taking loans from across the country, and they're successfully diversifying fire risk that by these loans, these pools of 100 loans, do not, you can diversify away climate risk by having loans in Maine, loans from San Jose, of pooling these loans together, safer assets emerge. And this is an example of how to use financial engineering such that our financial system faces less fat tail risk when inevitable climate shocks occur. Folks, a little bit like Roger Pilkey and Bjorn and others in this room, I continue to look for empirical benchmarks of adaptation. In a recent study with my friends, with Rajat, Shamik, Vahidi, and Sahil, we use lights at night. So floods continue to occur around the world. One measure of how much damage these floods do is how much do lights dim at night in the aftermath of a flood. In richer nations, they dim less and they recover faster. And so this is the flavor of the kind of big data empirics that I'm doing. Such big data work can't pinpoint the mechanisms, but it's quite a coincidence that richer cities in richer nations suffer less from the same punch from Mother Nature and recover faster. And so this Hoover theme of the fundamental role of economic development in improving all of our quality of life is a theme in my work. So folks, let's pick up a little bit of, whoa, that was so fast, we went flying. The prudent investor strategy to adapt to emerging climate physical risks. We know, coming back to one of Ken Judd's themes in the previous session, there's so many known unknowns about climate change. What does a prudent investor do, especially someone who is risk averse? We all seek to know where is higher ground. Terry alluded to that in his remarks about real estate. We're going to bid less for risky real estate. We're also going to hold more diversified asset portfolios going forward. We have several strategies to protect our families so that we can be safe and comfortable and rear happy, healthy children going forward. We're not passive victims in the face of the threats that we face. As Terry said, real estate prices under the efficient markets hypothesis reflect all anticipated risks we face going forward. That can be true for if a school district's getting worse, if a new transit highway is going to be built near an area. Real estate reflects location, location, location. Areas that are beautiful, safe, and have great access to jobs and great amenities have higher home prices. That's part of my optimism, that homeowners become an interest group seeking to protect their assets' value. Some libertarians would worry that they're going to try to, so let's do both of these. Whoops, I'm sorry, I'm still mastering PowerPoint. If an area fails to adapt to emerging risks, local homeowners will suffer an asset value loss and their insurance prices will rise. I think it's very important to raise this Milton Friedman point. Milton Friedman often spoke about other people's money. So if you own housing in a floodable area in Florida, you have an incentive to protect the area, but you'd especially like the government to subsidize your protection. And so I think a fundamental role that Hoover and the friends of Hoover need to think about is how do we construct the rules of the game. I am happier if we are treated as adults and we use our own money to seek solutions. When you are subsidized for your adaptation, someone else in that country pays. Ironically, someone pays on higher ground to subsidize another person's risky choice. And folks, that moral hazard creates bad incentives and creates ugly politics going forward. I am very interested in this new field, which is both art and science, of identifying. Climate scientists are doing this pinpoint studying of where is higher ground in terms of fire zones and flood zones. Folks, have you heard of companies like Jupiter and First Street Foundation? There's a growing set of firms who are designing models, and this is both art and science, because there's many assumptions built into these models of identifying what parts of every nation are relatively safer. Terry is from Montana. I bet that he has an intuitive notion of which parts are safer, and he should get paid for that information. I can tell you about West LA if anyone cares. And so what companies like, so we recently used these data in a paper we're going to release soon. We partnered with the company Redfin. Has anyone been on the Redfin platform? It's a Zillow competitor. Redfin always tells you the price of the home. Folks, they're no longer reporting crime data, and we can talk about why they don't do that. But they're now reporting climate data. They're reporting whether the home you're searching for faces extreme wind, temperature, and what we focused on was flood risk. So Redfin partnered with First Street Foundation. First Street Foundation is the firm who are making maps like this, which was published in the New York Times. So if you were on the Redfin platform in the year 2019, if you were in the randomized treatment group, all of a sudden you started to receive information on what were the flood scores you were looking at. Flood scores went from 0 to 9, so it's sort of like that movie Spinal Tap. They did not go to 11. And a home with a score of 9 or 10 is a home at flood risk. and a home with a lower score is a safer home. And we document in our paper that people who had previously been searching for homes in high flood risk areas, according to the First Street Foundation science, they substituted to searching and bidding for homes in safer areas. And folks, we found this in Trump counties and in Biden counties. So something that interests me very much is there is a divide between liberals and conservatives on support for carbon taxes and for government intervention. I have claimed that Republicans and libertarians, in their own privacy of their lives, we face trade-offs, and in private choices that individuals are taking this risk information into account, even if in their public life and voting, they're not prioritizing these issues. And of course, if you're a climate change adaptation optimist, that might dull your demand for a carbon tax, and we can talk about that. But folks, what I want you to take away from our new paper is that the American people, in searching for real estate, when they feel that they can trust information, they are responding and searching as informed adults. And this creates a demand. Such demand for safety creates entrepreneurship to innovate. And here are some examples of data. So I took a random house in Los Angeles that I happen to live in, and I give you the flood score, the fire score, and the heat score. And so these are the types of reports that before betting your life savings on a house, you're going to do your due diligence going forward. And that this is how the prudent investor adapts to climate change. This information can be acquired, and just as people search for school information and commuting information, this is another part of the trade-off. So some free market adaptation optimism, and let me put these up because Terry's looking at his watch. Information, even if it's imperfect, playing this Paul Revere role of informing us about the risks we face, has several market effects for entrepreneurs. The doom and gloomers in the New York Times often ignore the supply side. There's sort of this implicit assumption that we have this menu of products, like IBM computers and toasters from the 1960s. The innovation frontier is always shifting forward. We're going to see, for example, my colleague Marshall Burke here at Stanford has a new paper released today with co-authors of the challenge that people will face in the American West from PM 2.5 spikes. I've debated with Marshall that if people in the American West face more wildfire risk, we're going to see home renovation with better windows to make the house more insulated against this smoke. We're not passive victims here. And as we build up the human capital, there's always the question for young people, what's the next generation of jobs? We're going to see more and more jobs for middle-class jobs, which can't be outsourced, for people with the skills to improve real estate's protection against the threats it now faces. Terry mentioned pruning vegetation, improving indoor air pollution, trimming trees. These are all strategies for adapting to climate change. None of these is a magic bullet. This is not like a cure for Alzheimer's. This is small ball stuff that adds up, and it takes Nordhaus's mechanical climate damage function, the third equation in his Nobel Prize, and it flattens it. None of this is sexy, but this is the small microeconomics. So we celebrate Diet Dr. Pepper. We celebrate the Big Mac. We're going to get similar things in the adaptation space. And this isn't going to be due to a government mandate. It's not going to be due to a Greta scream. It's going to be due to aggregate demand, creating supply and incentives for the next Musk to step up here. So some products from Amazon. Amazon is already marketing at relatively low prices, $69 for these cooling vests that you can wear. Michael Boskin is a prominent economist at Hoover, and one of the themes in Boskin's work has been that consumer prices for computers, for cars, for cell phones are always coming down in price and of higher quality. The Boskin logic applies to adaptation products, and the next Musk and Bezos can make their fortune in these products. Here are some air filters for PM 2.5, and we're going to see this again and again when we face a challenge that creates a profit opportunity for entrepreneurs. So our theme today, we received this we received this it's discussion by Terry and Nick of what we were up to today. It's absolutely essential and plays into the Hoover agenda of promoting economic prosperity here. My vision for the federal government here is investment in satellite data and data sharing, the federal government playing a role as a knowledge broker of sharing the best ideas, Paul Romer's work on ideas as public goods. Milton Friedman emphasized the importance of helping poor people but not distorting their price incentives. Universal basic income. Jim Heckman's agenda on building up human capital throughout. And the final point is a slight libertarian point. Tough love. No bailouts of cities and subsidies for insurance and regulation required price ceilings. We need prices to signal scarcity, and then we will be the adults in the room. And so my final slide, everything I've said, by following this market-focused recipe for adaptation, there's a series of empirical implications, and my new Ehrlich versus Simon bet. I claim we're going to see, under the rules that I've sketched out during this quick talk, we're going to see more adaptation by firms. There's going to be lower prices, allowing more poor people to purchase these prices. We're going to observe fewer people dying in floods and disasters, fewer homes filing insurance claims, and a more robust economy such that we don't have that 23% reduction that Marshall Burke and that team predict. That's mechanical stuff. Economics is not a law of physics. Economics and physics are not the same field. The economic evolution of our economy depends on our rules of the game. If we unleash markets, we adapt to climate change.
As they're switching seats, I'm reminded that one of the few, maybe the only person who turned down an invitation to speak here is Judith Curry, who has a book, Climate Uncertainty and Risk. And Judith couldn't come because this is the beginning of the hurricane season, and she has a for-profit firm, hence markets, that deals with estimating these risks and providing the information to firms that might want to know what the hurricane risks are. So, you know, it's happening, and it's happening because you can't keep a good entrepreneur down. Take it away, Andrew.
Okay. All right. Well, thank you, Terry and Nick, for the invitation to come here. My presentation today is called How Are Property Insurance Markets in California Adapting to Climate Change? And what I'm going to do is summarize some of the results that I've been finding with my co-authors, Meredith Fowley, Judd Boomhauer, and Jacob Gelman, and that's in the paper referenced here. So the motivation for this work is that we've seen losses from hurricanes, wildfires, and other weather-related disasters escalating in the last 50 years, with evidence that this is being driven in part by climate change. And so this graph here shows that in real dollars since 1970, the global insured losses. And if you look to the right there, you'll see that in recent years, those green bars are indicating that wildfires are an increasing share of these losses. Now, property insurance markets, as was suggested by Terry, have a critical role to play in helping households and businesses reduce exposure to climate risks and recover from them when they happen. But to perform these functions efficiently, insurers need to set prices that accurately reflect these climate risks. Our paper is really focusing on wildfire, and in this context, we want to get prices aligned with risk to send the right signals to homeowners about location decisions. Where do they build their houses, as well as self-protection, which is things like defensible space that was mentioned before. So since 2017, insurers in California have sustained losses of $40 billion, and which is large relative to their profit, how much profit they make. And so what have they done in response to that? Well, one of the things they've done is to raise their prices. And so this graph is showing since 2009, the average premium per $1,000 reconstruction costs broken out by different bins according to the wildfire hazard. So the orange line at the top is the most risky zip codes. And what you see is that prices are higher there and have increased more over that period of time. The other thing that's been happening is availability has been decreasing. We read a lot about this in the newspaper, where people are being dropped by their insurers, and we see this documented in the figure on the left, which shows that since 2009, there's been a 10% decrease in the number of private market policies that have been been offered to or sold to customers in California. So people, for reasons I'll talk about, need to have homeowners insurance. What do they do if they can't get it from a private market vendor? Well, they go to they can go to the FAIR Plan, which is a publicly run exchange actually underwritten by private insurers. And what we see on the right there is that the number of FAIR Plan policies has increased substantially over time. Okay, so what we're seeing are rising premiums. We're seeing stricter underwriting practices in high hazard areas. These could indeed just reflect an efficient industry response to increasing risk. So risk is going up. We would think that prices and perhaps availability would change in response. So what we do in this paper is to ask the question, first of all, well, when we look at prices, are they aligned with risk in the way we'd want them to be to send the right kinds of signals to homeowners? We're going to find the answer is basically no, and then we're going to search for explanations. One of the things we document is that there's a great deal of heterogeneity among insurers in the information they use to price wildfire risk. This gives rise to the potential for adverse selection, as I'll talk about, and we're going to explore whether prices are affected by adverse selection among insurers. The other point here is that the insurance markets, as was mentioned by Terry, are heavily regulated. And so one possibility is that prices, while they've gone up, they haven't gone up enough if they're being constrained by regulation, and perhaps that's also contributing to some of the lack or decrease in availability that we've seen. Okay, so a little bit on markets very briefly for property insurance, or particularly for wildfire risk. So unlike flood insurance, earthquake insurance, wildfire damages are typically covered by private insurers, and they're bundled as part of, with other perils as part of a standard homeowner's insurance policy. Now, mortgage lenders require that you have insurance, and because most U.S. households have mortgages, most U.S. households have these kinds of insurance policies. I'll just mention that because this is kind of important to understanding our results, is that as in other insurance markets, we find evidence of inattentiveness among consumers, switching costs, brand loyalty, those sorts of things that prevent people from just switching between insurers when there's a small difference in price. Regulation. So I said that this is a heavily regulated market, and let me give you basically how it works. So in California, if you're an insurer in the admitted market, which is where all the big players are, you can't just charge any price you want. You have to have premiums pre-approved by the California Department of Insurance. And the way it works is basically if you're an insurer and you want to increase your rates because, say, risk has gone up, what you do is you file a rate, you do a rate filing asking for an average increase in premiums across your book of business. And the way you justify that is by looking back at your historical losses. So basically the system is one where it's a sort of a loss recovery system. You get to build losses into your rates going forward. The one important point, though, is that if you get approved for an average rate increase, the insurer can then allocate that across different market segments using other kinds of methods, using other kind of information, such as forward-looking catastrophe models. And what's really interesting is that in response to the rising risks, we've seen a lot of innovation along the lines of what Matt Kahn has been talking about in wildfire risk modeling and pricing. Historically, insurers in California just priced wildfire risk at the zip code level. So they'd calculate a premium, there'd be a factor for the zip code where the house is, and that would just get built into that rate. After 2010, insurers started to use property-level categorical risk scores. So for example, CoreLogic has a product called the Wildfire Risk Score, which is a 5 to 100 index of wildfire hazard, combining information for the property about fuel, slope, access, and so on. There are insurers now who use that wildfire risk score to price risk, but there are other insurers who are even more sophisticated, and they're using cutting-edge wildfire catastrophe models of the sort generated by First Street Foundation to generate granular dollar-denominated estimates at the property level. So again, CoreLogic has a product in this space that basically measures the risk for a property from wildfire, or the average annual loss or the expected loss from wildfire. These estimates, in addition to reflecting wildfire hazard, also account for things like building characteristics and other factors. Okay, so this is a table that documents the degree of heterogeneity among insurers in how they price risk. And basically, the pattern here is that the bigger the firm in terms of market share in California, the more sophisticated they are. So at the top, you see State Farm is the big player, 18% market share in the state, a lot of exposure in high-risk areas, and they use thousands and thousands of different variables to basically price wildfire risk. You go down the list and you get to the smaller players, like, say, Nationwide and Allstate, and they have relatively small market share in the state, and they just use that wildfire risk score, that 5 to 100 score that I mentioned before. Okay, so this sets up then the possibility for adverse selection. So let me just say briefly sort of how it's going to play out in an insurance space. So adverse selection in general arises when participants in a market have different information, and this can lead, as is well documented, to market inefficiencies and, in extreme cases, market collapse. So the story in the health insurance market would be something like the bad customers push out the good customers, and eventually the market unravels in what's called the adverse selection death spiral. In a property insurance market, however, as I mentioned, customers aren't going to be leaving the market because if they have mortgages, they have to have insurance, so effectively buying insurance is mandatory. However, there could be adverse selection, or we actually show there is adverse selection among insurers. So in particular, if you're a low information firm, you should really worry about getting an adversely selected group of customers. In other words, ending up with all the high-risk customers. And the way this would work is, let's say you're an insurer like Allstate, who sets a single price for all properties that have a given wildfire risk score, but then you're competing against a high-information firm like State Farm. State Farm can come in there, identify which of those customers are low risk, pick them off with low prices, and Allstate and Nationwide end up with the high-risk customers. Now, if you're a low-information firm who's also rational, what you're going to do is raise your price to guard against these unprofitable high-risk customers. This kind of price increase is analogous to a winner's curse kind of adjustment, but that we find in common value auctions, but that plays out here in insurance markets. Okay, so just one slide to show you kind of how we document this. What we're after here is sort of the price for wildfire risk. And so that's going to be measured by beta here. And that is basically what we're after is how much is an additional dollar of expected loss or risk being priced. So if you imagine a house, the expected loss goes up by $1. How much does the price change? The first thing we do is to develop a risk-based price, so a price that would accurately reflect risk, and that beta would be equal to 1, first of all, because if expected loss goes up by $1, price should go up by $1. But you also have to, in a catastrophic insurance market, account for risk load, and that's what's called the marginal surplus cost. And basically, this is the cost of having sufficient reserves to pay out all your claims in a catastrophic loss year. we estimate conservatively that the marginal surplus cost for California insurers is 18 cents per dollar of risk, giving us a risk-based price of $1.18. We then take rate filings and lots of other data I'd love to talk to you offline about how we do it, and we go out and measure the actual betas for a group of large insurers in the state. We find that State Farm is right on our risk-based price. They have a beta we estimate at $1.18. Remember, they're the high information firm. We now turn to the low information firms like Allstate, Nationwide, USAA, and Liberty Mutual, and they have much higher betas. They're charging much more for wildfire risk compared to State Farm. And what we show is that the reason they're doing this is because they're getting in adversely selected samples. So for example, when Allstate gets a customer, charges a lower price to a customer than State Farm does, you can think of that as sort of winning that customer, the expected loss for that customer is 51% higher than when State Farm wins that customer. And this is true across the other low information firms, and it also plays out in terms of them earning lower net revenues compared to State Farm when they win customers. Just very briefly, this is a graph that's showing sort of how you could calculate different betas for different market segments. And the point here is only to say that in the really high market segments, what you can see is some kind of flattening of those prices for wildfire risk. So in the really risky places, we see what looks like some kind of compression of prices, which could be due or certainly would be consistent with regulation. And so let me end with just a couple points about that. This graph is showing the rate requests for all admitted market insurers over the period 2008 to 2023. You'll notice that the requested rates tend to bunch up right at 7%. Okay, so why is that? Well, if you file a rate request of 7% or lower, then that rate filing is handled internally by the California Department of Insurance. If you go over 7%, then you open yourself up to public hearings where interveners, consumer watchdog groups, et cetera, can come in, and that turns into a much more lengthy and costly procedure. So what insurers do is they basically file 7% so that they don't have to go through the public hearing. So that would be consistent with this idea that we're preventing prices from rising enough in some of those high-risk segments. It is worth mentioning, however, that it's possible and for insurers to just do one 7% rate filing after another and ratchet their prices up over time, and we actually see that firms are doing that. So with that, I'll just conclude that and restate or summarize our findings. We find that prices for insurance in property insurance in California are departing significantly from risk-based prices, particularly for low information firms. The price adjustments that we see are in these high-risk segments are consistent with winner's curse kinds of adjustments. And then finally, we find some evidence of rate compression in high-risk areas that would be consistent with binding regulation. And with that, I'll stop.
Well, thank you, Andrew. And Matt, we'll take some time now for questions. I'll start just, Andrew, it seems to me the next step, I like to tell people what research they should do, is are people actually responding to this? Are people saying, well, I'll pay more for a house where where I can get incorrect, if you will, insurance prices than I would for a house that I get the correct insurance price? Do you have any data on that, or?
I mean, I certainly have anecdotes about that where people are finding, in these high-risk areas, they're either finding prices that are extremely high or they're having trouble getting insurance at all, so they're ending up on the FAIR plan. And at least anecdotally, that seems to be pushing, making people reconsider some of their either purchasing decisions or their building decisions. So I think the answer is yes on that.
Wait for the mic, but I'll try and catch you so you get it.
Andrew, I'd seen this paper presented before. It's fantastic work. Thank you. Does this suggest that the cost structure of the insurance industry when facing these complicated risks is making it something like a natural monopoly, like the efficient way to insure in California is just one firm that invests in specializing in understanding risks, or is there sort of some other efficient way to think about pricing risk?
Yeah, it's a great question, and I mean, I think that if one possibility would just say State Farm, you do the whole market. I mean, of course, in a market where basically demand is very inelastic, then I think you'd worry about the monopolist, if just left to their own devices, is going to charge extremely high prices that will not then be aligned with risk. So maybe you want to do more than just turn it over to one firm.
But I jump in that if capital markets, it's a global market. So, this could be, so similar issues arise around the world. So there could be global competition here. And there's always a question in industrial organization, how many firms do you need to bring about the benefits of competition? But this could be a global, we've seen with catastrophic reinsurance that this is a global market. So, and so I don't, but that's a testable hypothesis.
Okay, but are you, what do you think that so one firm is a bad idea or a good idea?
I prefer to have a clash of the titans, that we would have 3 or 4 firms that are global firms doing their homework. So
but
we
these
live in
these are big firms who buy reinsurance on the global market. So they are, I mean, we have a lot of firms in there who are relatively sophisticated.
But I thought that your empirics showed that there is an adverse selection issue here. If Tesla faces another superstar firm, this brings about a proper competition. So if your major firm had a major competitor, would that alleviate the adverse selection issue?
Well, they do in the sense like Farmers is a pretty major firm that's similar in some respects to State Farm, but the issue is with the small. The small players are the ones charging the really high prices, and they're doing that again because of inattentiveness, switching costs, that sort of thing. That's why they're able to do it.
But a libertarian question there. It's not state barriers to entry for foreign insurers to step in.
Oh, I'm not sure about that. Yeah.
Well, I was going to suggest one firm with easy entry.
Competitive fringe.
I mean, the other, oh, yeah, we can, I was going to say something else to Dan, but we can move on.
Question over here.
Yeah, thank you. Really interesting panel. So you both either directly or indirectly said the government should allow markets to sort these things out, including effectively allowing people to be punished for making risky decisions. And I'm reminded of Kydland and Prescott, right, who basically say, people know that the government, when push comes to shove, will bail them out. So in the theme of markets versus mandates, how do you apply Kydland and Prescott to avoid that situation or to avoid that inefficiency?
So there's 2 things going on. A benefit of the American deficit growing is bailouts may not be fiscally possible for that much longer. That was a half joke. And second, if more of us are renters, so the subsidies for home ownership are actually slowing down adaptation. If more of us were renters, we'd rent from professional management companies, and they might have the clout and data and management to do a better job handling these issues. But Matt's point is crucial.
Sorry, here. In the previous session, there was a discussion of how cost-benefit analysis evolves over time. And it seems like this 7% cap on in-house rate evaluations has some similar qualities. It's forcing them to make these changes over years. But what you didn't talk about is the time scale at which it comes to some market equilibrium. In other words, it's regulatorily constrained for a while, but it may, depending on how rapidly the risk is rising, it may actually be approaching market equilibrium. Can you comment further on that? That is, how long is it going to take for the market to catch up with the risk?
Right. I mean, I think if we go back to State Farm, who has a good handle on the risk, and as we saw, are basically pricing in a way that reflects risk, and they've done these kinds of serial filings over time, it seems like they've got prices pretty well aligned with risk. And so in that sense, there's a constraint year to year in how much they can raise their rates. But I think the evidence we have suggests they've been able to do it in a way that has made, at least for that insurer, prices that are aligned with risk.
And if risk really went high, there can always be managed retreat from those areas. The Coase theorem might say that we might pay these individuals to move away if they have the right to live there. And that gets back to local zoning. I see that Palo Alto doesn't build much housing. I had a recent student at USC who wrote her thesis that middle-class people are moving to fire zones because progressive big cities aren't building housing. So there's an interesting question of how people end up in fire zones and under what different land use regulations would the demand to be in these risky areas decline.
Right. Yeah, and there's no question that there's incentives for moving into those areas. So for example, insurance markets might be telling you, don't go there, but then you can go to the FAIR plan and you can get a public policy. But those, again, there's a lot of reasons to be concerned about those public options too, because now the states are taking on a lot of risk that may not be sustainable in the long term.
Yep. Oh, wait. Sorry. Saw this one first.
Market.
Question for Andrew. The excess and surplus lines are like a leakage out of this system. So is the linkages between auto and homeowners. Have you, first very particular question is, did you exclude excess and surplus lines? Second question is, have you tried to investigate, there's no way Liberty Mutual is running at the kind of results that would be implied with that pricing because they're making it up on auto. And I'm just wondering if you looked at any of that.
Yeah, so we don't treat the surplus lines because when we are calculating, we basically recreate the whole set of offer prices by firms in the admitted market. But to do that, we need the rate filings, and the rate you have to be in admitted market, then you do the rate filings. Surplus lines for others, this is like, Lloyd's of London will write you a insurance policy for just about anything, including a house in the wildland urban interface in California. And so that's what the surplus lines end up. But we haven't had a opportunity to look at that because it's not regulated in the same way. And then the other, wait, what was the second piece? Oh, right. Yeah, so we do observe all of that in the rate filings. And so what we do is we have we just standardize those features of the insurance contracts across all of the different insurers that we're considering, so that I think it's auto bundled with homeowners is like in all of those estimates that we have.
At the risk of the questioner and the people answering standing between this audience and the eclipse, that's similar to the bar. For me, the bar would be much worse if you were standing between me and the bar. But anyway, we'll take a last question from Steve and quick answers. So, Steve.
So thanks. I want to focus in on the component of the risk associated with climate change, since many other things we've been talking about forestry practices or local drainage systems and so on. And the risks associated with climate change, I believe, are projected from these large climate models, GCMs. And when you talk to the people who develop the models, what they will tell you is they give a hazy picture at the global level, and at the local level, to use the technical term, the results are garbage. And you can see that by looking at the IPCC. They can't even tell you whether it's going to rain more or rain less in a given region. So how do the insurance companies handle all of that?
Oh boy. I'll give you not a very satisfying answer. They go to private companies like CoreLogic, and there's a bunch of other ones that produce these products that give them that information. But yeah, where is that coming from? And honestly, they're black boxes. They're proprietary models that we actually bought results from, but you can't look under the hood for them. So that's my unsatisfying answer to you.
So Steve, on that, I wrestle with the issue you're raising, sort of type 1 versus type 2 errors. Do we prefer to execute the innocent man or release the guilty man? And so I wrestle with this issue of whether even a noisy signal beats it. If I accept everything you said, is ignorance bliss? And maybe we end on that philosophical note.
Well, join me in thanking them. I think this topic is just, I think, so important to the climate change debates and markets versus mandates, and yet one that gets not enough attention, but these two people have certainly brought more attention to it, and not just attention, but data. Thank you very much.
Great job.